What's up, people? So, you got your emergency fund in order, you're tracking your spending, you got your income up, you paid off your high interest debt. Now it's time to make money, right? The answer is complicated. So, first thing you need to worry about is whether or not you want to invest in retirement accounts or in private stock market accounts. And I would pretty much always recommend that you worry about the retirement accounts first. And unless you have a clear path to retiring long before you're 60, you should probably be worrying about individual stock market accounts. If you don't have that clear path, you need to worry about your retirement accounts first, because you don't want to be 75 years old and having to get a job as a cashier at Walmart because you can just not make it on your own. So, for most of us, that means first get the 401k, and you need to always get the company match. If your job has a 401k, if there's a company match, always take the free money. There's almost no situation in which not taking the free money is going to be good for you. After you take the employer match, you can wonder whether or not a Roth IRA is better or the 401k. You can contribute over $19,000 every year to a 401k, which is pre-tax money, which means you don't pay income tax on the money that you put into your 401k. You do pay income tax when you take the contribution from the 401k. But generally, you're going to be in a lower tax bracket after you retire because the money coming from your 401k is going to be less than the money that you make now to put into your 401k. And experts suggest that you need to save about 15% of your income every year to not have a downgrade in lifestyle when you retire. And that means if you don't contribute 15% to your 401k, you're going to pay a lower tax rate when you get the contribution from the 401k than you do now, which means you're saving a lot of money on taxes, which gives you a growth until then. And the 401k does not just stop growing when you turn 60 or 59 and a half, which is the cutoff. You can take distributions, and all the money you leave in there is going to keep growing. And if you do everything right, in the first few years, you might actually grow your 401k while taking distributions. So make sure you get the company match always, and then worry about if you want to take pre-tax money to stick into your 401k or post-tax money to stick into your Roth IRA. And what that means is all the money that goes into a Roth IRA is money that you have already paid income taxes on. And the amazing thing about the Roth IRA is after you retire, you don't have to pay taxes on the contributions. So if you stick $10,000 into your Roth IRA when you're 20, and that magically grows to $1 billion by the time you retire, you don't pay any taxes on the $1 billion. And while that is unrealistic and illegal because you can only contribute $6,000 a year, you have already paid the income tax on the money you put into the 401k, so you don't pay any taxes when you get money out of the Roth IRA. Roth IRA, not 401k. So 401k, you don't pay taxes now, you do pay taxes later. Roth IRA, you do pay taxes now, you don't pay taxes later. So a Roth IRA is amazing if you currently have a low tax rate. Like say you have your first job, you have $500 every month left over. You can stick all of that into a Roth IRA and you will never pay taxes on that money, even if it grows to millions of dollars. So After getting the emergency fund and the spending and the income all in a good place, you worry about the retirement accounts. And when you're done with that, which means the maximum contributions of 19,000 and 6,000, which you can do simultaneously, after that, you can invest your money in non-retirement accounts. And that is fairly easy. It takes some shopping around to see which company has a good stock market account. And two good ones are Vanguard and Fidelity. And basically, unless you really know what you're doing, you should probably just stick the money into a index fund. Vanguard has a S&P 500 index fund, which basically just tracks the S&P 500, which is the 500 biggest companies in America. And if those, on average, go up on the stock market, you make money, which comes down to a return of about 8% a year. So without too much of a hassle, you can just stick your money into an index fund and get about 8% annual return on that. And if you compound that, it tends to grow extremely fast. So the amount of money that you have in there doubles every 7 to 8 years. So you stick $10,000 in there, even if you don't contribute anything else, in 8 years you'll have $20,000. So that's it in a nutshell. There's a lot more to it later that I will go over, but that is the basics that you need to worry about as soon as possible.